Silver didn't just hit $100, it broke the rulebook. For decades, silver was trapped under one number, not by charts, by psychology. 2 digits meant you could wait. Triple digits means you may never get a clean entry again. Silver has cleared $100 and traded as high as $115.59 in spot markets, with Chinese futures printing over $110. That's not a test. That's a structural shift into price discovery, where old resistance stops existing and new floors form fast. But here's the part nobody is saying out loud. This move changes your behavior more than your portfolio. The old wait-and-see strategy worked when $100 was a ceiling. Once $100 becomes a base, waiting becomes a risk. And the paradox is brutal. The higher silver goes, the more buyers it attracts. It stops being a value trade and turns into a momentum machine. Now watch how fast this escalates. Because the next threat isn't price, it's time collapsing. Most people think the story is silver broke $100. That's the headline version. The real story is what happens after the number stops working. The move from $20 to $30 took 145 days, but the move from $90 to $100 took just 10 days. That's time compression. The market isn't walking upward anymore. It's sprinting, because liquidity is thinning and momentum is feeding on itself. But notice what they didn't deny. Nobody is arguing whether silver should be above $100. The debate has already shifted to the next psychological shelf, $150, even $200. And some forecasts are now calling those targets reachable in weeks, not years. This is where the story flips. When price starts moving faster than your decision-making process, your old strategy becomes your enemy. Weekly analysis becomes too slow. Monthly waiting for a pullback becomes fantasy. In this environment, a $10 move isn't a quarter. So, the question isn't, is silver expensive? The question is, what happens when you hesitate and the market moves without you? Because once velocity takes control, the next step isn't a trend, it's a melt-up. The smartest mistake people make right now is assuming high price means high liquidity. It doesn't. Refiners have effectively stopped buying alloyed silver products, like 90% constitutional coins and sterling. Some are refusing it outright. Others are delaying payment from 10 days to 3 months. That creates a liquidity trap, where the metal is worth more on paper, but harder to convert into cash when you actually need to move. Here's why that detail changes everything. Most retail investors think silver is silver, but the market is splitting in two. Pure 0.999 fine bullion stays liquid. Secondary legacy silver becomes a slow asset, not because it isn't valuable, but because the exit door narrows. Dealers don't survive on theory. They survive on cash flow. They buy, flip, repeat. If they can't unload 90% coin banks quickly, they stop bidding aggressively. And when dealers stop bidding, the spread widens. You can be up massively and still feel stuck. But here's the part nobody is admitting. This bull market isn't just about price going up. It's about the infrastructure underneath the price starting to break. And once that happens, the next escalation isn't a chart move, it's a system move. Now look at the signal that doesn't come from traders. It comes from the sovereign. The United States Mint repriced proof silver eagles to over $170 per ounce, roughly double the spot price at the time. That isn't just higher costs. That's a forward-looking floor being quietly installed by an institution that refuses to sell future silver at today's price. This is where the story flips. Because most investors watch spot like it's reality, but official pricing is a different kind of reality. It's what a system actor is willing to charge when it believes the move isn't temporary. And the most important implication for you is simple. If the sovereign issuer is comfortable putting a $170 tag on a silver ounce, then $100 to $115 stops looking like a peak. It starts looking like the beginning of a new baseline. But notice the contradiction. On one side, the official channel is pricing high. On the other side, local secondary markets can still sell closer to spot plus a smaller premium. That gap creates an unusual window. The official price says silver is re-rated, while the street price still lags behind. Now watch how fast that window closes, because when retail demand hits full panic, the street price doesn't stay cheap for long. This is the phase where the market stops acting rational and starts acting human. Dealers report a whole new universe of uneducated buyers entering the market, chasing headlines and reacting to visible dollar erosion. Despite purchasing 6 figures of inventory daily, showcases remain empty because retail offtake is instant. That's a Veblen good effect. Demand rising because price is rising, not in spite of it. But here's the part nobody is saying out loud. The frenzy itself becomes the engine. Not fundamentals, not charts, crowd psychology. And when that happens, premiums don't behave normally. Scarcity gets local. A shop can be wiped out in a morning, even if the global market still has supply. You'll see silver available on a screen and unavailable in real life. This is where sophisticated behavior matters. You don't want to become the person buying the green candle at the worst possible moment. You don't want to be forced into panic buying during an intraday spike because you're afraid of missing the next leg. The advantage goes to the calm buyer with access, the buyer who has relationships, the buyer who moves during brief lulls when the crowd exhales, because mania creates 2 markets at once, the one you can quote and the one you can actually touch. And now we reach the shift that would have sounded impossible in the old silver world. There are 10 million shares available to borrow for shorting silver. Yet there are virtually no takers. Attempting to short is described as pure insanity. That's institutional capitulation. The trade that used to lean against rallies has stepped back, either because the risk is too high or because the incentives flipped. Notice what they didn't deny. Nobody is confidently saying, this will be slammed down like before. In past cycles, the fear was always the same. A sudden $5 smash in minutes, a violent flush engineered by heavy hands. But this time, the structure looks different. If major players have already accumulated physical positions, their incentive isn't to crush price. Their incentive is to let it run. And that changes your entire timing model. The old logic, I'll wait for the manipulation crash and then I'll buy, becomes a trap. Because if the crash doesn't come, or if it comes shallow and gets bought instantly, you lose the entry you were counting on. This is where the story flips again. The ceiling isn't being held down by force anymore. It's being pulled upward by absence. Absence of sellers, absence of shorts, absence of hesitation. Now watch how fast this becomes unstoppable. Now add the fuel that never truly leaves the room: geopolitics. The source describes kinetic risk near Iran, the ongoing war in Ukraine, and aggressive moves like the desire to acquire Greenland, creating a persistent fear premium under precious metals. That means silver isn't just a trade anymore. It becomes insurance, because the world is no longer pricing stability as the default setting. But here's the part nobody is saying out loud. We used to live in a system where one crisis ended and the market calmed down. That rhythm is fading. The peace dividend that kept inflation and rates suppressed for decades is gone, and the replacement is constant friction. So even when one front cools, the next one heats up. Even when headlines go quiet, risk doesn't disappear. It relocates. And this changes how you should behave. You don't liquidate your insurance because the sky looks clear for one day. You don't treat a temporary lull as a reason to dump a structural hedge. This is why silver stays bid, even when traders expect it to breathe. Because capital isn't just chasing profit, it's fleeing surprise. If this feels familiar, say so in the comments. Because the average person doesn't realize what's happening until it hits their rent, their groceries, and their savings all at once. And the next part is where the real engine shows itself. The price isn't being set in the West anymore. The screen price you see is not the whole price. Not anymore. The Shanghai Futures Exchange is trading silver at about a $10 premium over Western spot prices, pulling physical inventory out of Western vaults. That means the center of gravity is shifting east. Western spot becomes the lagging indicator, not the leader. Here's why that detail changes everything. If silver is meaningfully more expensive in China, the market doesn't politely average out. Metal moves. Inventory relocates. Arbitrageurs do what they always do. Buy where it's cheaper, sell where it's higher, and drain supply from the leak side. So, every dip you see in US pricing starts to look like a temporary discount in a global auction. Because if the spread stays open, the West either raises prices or loses the metal. But notice what this implies about the dollar system. For decades, the dollar-based price was treated as the global reference point. Now the reference point is being challenged by a premium market willing to pay more, faster, and in size. This isn't just about silver. It's about who gets to define real value in a world where trust is fragmenting. And once price discovery migrates, pullbacks stop being relief. They become targets. Because the moment the market hesitates, the global bid steps in. Now watch how that forces the next strategic decision. When silver runs this hard, smart money starts planning the exit. Not out of fear, but out of math. When silver breaks $100, people ask one question: how high can it go? But the better question is, when do you turn volatility into permanence? The gold-silver ratio has compressed below 50 to 1, with gold near $5,000 and silver over $100, meaning silver is outperforming hard. The source suggests the ratio could fall toward 30 to 1 or even 15 to 1. That's the classic late-cycle setup. Silver becomes the high beta weapon, and gold becomes the vault you move into after the run. This is where disciplined investors stop thinking in price targets and start thinking in conversion windows. Because silver can make you rich fast, but it can also take that richness back fast. The asset itself is designed to swing. So the strategy isn't sell everything or hold forever. It's rotation. Staggered rotation. You shave some silver strength into gold stability as the ratio compresses, locking in gains without pretending you can top-tick the mania. But notice the emotional trap. When silver is ripping, rotating feels like betrayal. It feels like missing the next leg. That's how melt-ups keep people glued until the cycle flips. The point is not to predict the exact peak. The point is to survive the peak with your wealth intact. Because in every precious metals blow-off, the winners aren't the loudest bulls. They're the quiet ones who convert momentum into something that can't evaporate overnight. And now comes the next layer, the leverage trade, the place where fortunes multiply or disappear. If physical silver is the engine, mining equities are the turbocharger. And right now, the turbocharger is starting to spin. The source describes bought deal financings happening without warrant sweeteners, a sign of strong institutional demand flowing into mining. It also argues there's a valuation disconnect, where juniors can be undervalued relative to producers. That means the market is moving from metal is rising to supply replacement is urgent, and miners become the battlefield where majors are forced to act. But here's the part nobody is saying out loud. Most miners aren't investments. They're distractions. The space is filled with companies designed to survive, not to succeed. Lifestyle management teams, perpetual dilution machines. That's why selection becomes everything. The source points to district-scale high-grade potential and modern, younger exploration teams using advanced structural modeling, what it frames as Gen Z mining. The advantage isn't hype, it's competence. It's finding stacked structures that older methods missed. And the exit strategy here isn't hold until dividends, it's acquisition. When majors can't replace reserves organically, they buy. M&A becomes the payout mechanism. But notice the danger. Miners add operational risk. jurisdiction risk, and liquidity risk on top of metal volatility. That leverage cuts both ways, which brings us to the final hidden layer most investors ignore. The rules of the game change by location, not by charts. The last risk isn't price, it's friction, the kind that turns a winning position into a hard-to-use asset. Washington State's 10% bullion tax has pushed buyers into Oregon, damaging local businesses and forcing users to travel hours to transact. The source also notes behavior around cash transactions under the $10,000 reporting threshold. That's jurisdictional arbitrage, not a theory, behavioral proof that bullion markets are shaped by law as much as by supply and demand. Here's why that matters for you. Silver is portable wealth, but only if you can actually move through the system with it. Taxes, reporting rules, and dealer restrictions don't show up on a price chart, yet they can change your real return overnight. In a bull market, people ignore these frictions because price appreciation hides the pain. But when the cycle gets more chaotic, or when governments get more desperate, those frictions spread. Today it's one state. Tomorrow it's several. And once policy locks in, the market reroutes capital like water around a dam. So here are the three futures your source implies. In a melt-up scenario, silver goes parabolic toward $150, then $200 fast. And the smartest move is not trading noise, it's holding through velocity. In a structural grind, silver consolidates above $100. Pullbacks become accumulation windows, and rotation into gold becomes the disciplined trade. And in the liquidity trap, spot stays high, while real-world exit routes narrow. Dealers tighten spreads widen, and you're rich on paper, but slow in cash. One sentence reframes the entire story. Silver above $100 is not a price level. If you want the next layer of this analysis, how to position for these scenarios without getting trapped by premiums, liquidity, or bad timing, follow and subscribe, because the next move is already forming.